Before you just drop all of your money into a high-yield savings account, keep in mind that timing is everything. Do not miss the boat on this. The last time interest rates were this high in high-yield savings accounts was in the 1990s. Right before COVID, my interest-bearing accounts earned less than $1 a month. After the rate hikes, some accounts were generating real interest income. I mean, into the four figures. I have my money in a few different high-yield savings accounts right now, and I don't see it as an investment option. I just see it as somewhere that I'm holding some cash while preparing to deploy it into investments. Why not earn while this possibility is available? If you decide to use this temporary strategy, understand a few things before you open an account. Do you know how banks make money? They don't just leave money in cash reserves. When you are a customer of a bank, you're a depositor. So you are depositing money into the bank, and the bank is lending that money out to other people in order to make a profit, pay you the yield that they said, the high yield that they said that they're going to pay you, and then also make money. They need to make a profit. They need to pay their shareholders, so on. So basically, as soon as you put money into the bank is lending it out. They lend money to other people, to businesses, through the credit cards the bank has, to the government. They're not just keeping that money in cash. They're using it to make more than the percentage that you're making on that money. They should keep plenty of money on hand so that they have cash reserves. So when you go to the ATM and you try and pull money out, there's money there for you. Sometimes you'll notice if you go to the bank and you try and pull out too much money at once, or you try and cash a big check, the bank doesn't have enough money to pay you, or they tell you to go to a different branch, or they say you have to wait a few days, or whatever happens. So keep that in mind. This is how banks make money. It's important to have an FDIC insured account. That way, the money you put into the account is insured by the government, usually up to $250,000. So if the bank fails, you will be able to recover your money. And one way to hedge or protect yourself is don't deposit more than $250,000 into any one account. The third thing you should know is that earning interest can preserve your money. If you're thinking about putting your money into a high yield savings account, you probably know that yield is the income you're earning from an investment. It's usually a percentage, it's usually calculated annually, and sometimes it compounds daily. There are plenty of high yield savings accounts today in July 2024, the end of July 2024, since timing is so important. Plenty of accounts that'll offer you 4%, 4.5%, maybe even more, depending on the terms you're willing to agree to. So you can get a 4% yield on your deposit. For example, if you put in $100,000 at the end of 12 months, you'll see an additional $4,000. Here in the US, the Federal Reserve raises rates when they're trying to slow money down. You might have noticed that people aren't really jumping to buy houses like they were last year because they're like, oh my God, 7% rates, and then it just slows things down. Or if you're looking to buy a car and suddenly interest rates are way higher than they were just a couple of years ago, you might hesitate on buying a car. On the other hand, when the Fed lowers rates, then that stimulates the economy and makes people want to buy a bunch of stuff when you're like, oh my gosh, real estate's free because rates are at 2% or 3% like it was 5 years ago, 6 years ago. The important thing to remember is that the Fed is aiming for 2%. And they have this on their website. It's a very clearly stated policy. They're trying to hover right around that because that's where they think the economy operates efficiently. It's a good thing to keep in mind. If you put your money in the account today at 4%, that could change, right? The Fed can drop interest rates. The bank can respond. Usually they're passing their savings on to the customers, but if they're losing and borrowing money costs more money, then they can reduce the yield that's going to you. So it's time limited. The fifth thing to consider is that not all banks are created equally. You might be tempted by a really high interest rate, but at the end of the day, their terms and conditions are not your cup of tea. And when you look into it, it's like you can't pull out your money for a certain amount of time, or there's limits on how much you can put in, or there's a minimum that you have to put in, or maybe they charge you fees, or they only have an online version and you can't just go up to the ATM and pull money out if you needed to. Some places just have a yield set for marketing purposes. And so they might say for the first 2 weeks, or depending on how much money you put in, you can have the 6% rate, but then after 60 days, it's going to drop down or whatever. No guarantees. See what the bank's asking of you in order to get that high percentage. Here you see everyone gets the same rate, whether or not you put in $1 or $100,000. If you're a nerd like me, you go to the disclosures, download the terms and conditions, read all the fine print. This one's only 41 pages. I mean, you're telling me you don't click on all this and read all this too? But honestly, most people don't read this stuff because they can't change it anyway. Terms for savings accounts like these are usually take it or leave it. You can find the basic information you need in the sales pitch. For instance, this account offered by Allie, there's a lower interest rate, 4.2, but maybe you like the terms better. The key terms are easy to find on the website. No fees, no minimums, interest compounded daily, real people instead of chatbots. And that brings me to the sixth thing you should know when you're opening an account, which is that this might not be the best return on your money. We're talking about 4 or 5% here. A lot of investments today can earn much more than that. Case in point, here is the stock price for Ally, the same bank I just showed you with the savings account. So if you look at the last year, the stock's up over 43%. That's 10x what they're offering in their savings account yield. But of course, stocks are volatile. So if you look at the last 5 years, you see it bounces up and down a little bit. Let's look at Amex. They're offering a savings account with 4.25% yield. Their stock price is up over 44% over 1 year. Bank of America, still pretty exciting at over 28%. So this is a real example of how you can make more money investing than leaving your money to sit in a savings account. But stocks are volatile. And like all investments, returns aren't guaranteed. And banks don't always perform year after year. Look at this bank that failed last year. The stock price rallies and then boom, flatline. Zero. Meaning if you put 100,000 into this stock, you would have lost everything. This might not be an investment for you. This might just be somewhere you're placing money until you're ready to deploy it into another investment that might earn you 5, 10, 20, 30, 100%. Who knows? The world is your oyster. So for right now, since this is available, the reason why I stash some liquidity into the high yield savings accounts is because it's easy to get it in and out. And right now they're offering such a high percentage, it's beating out some of my real estate investments. But the moment that rates drop, I'm going to move money again. And this is just my personal strategy right now. Of course, I'm not your lawyer. I'm not your broker. I'm not a financial advisor or anything like that. Research, do your due diligence. These are just a few considerations before you open up an account. There's so much more, but at this point, I feel like I'm rambling. So feel free to get in touch if you have any additional questions. Thanks.